Hey, hello investors and future investors. Welcome to the channel. For today's video, I'll be giving you the top 3 ETFs that can be used if you're new to options trading or if you're trading with a small account. I will give you a step-by-step walkthrough using one example with an option strategy to show you how you could use these 3 ETFs in order for you to make consistent income. So if you're new to options trading or you're trying to use options in order to make some extra money to supplement your regular 9 to 5, then you so happen to stumble onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, I'll be running you through the top 3 ETFs that could be used in order for you to grow a small account. I'll be using a single option strategy to demonstrate how you could continuously keep making income with these 3 ETFs. Now, you guys know how we do it. We're going to go ahead and get down and dirty with options. So, that being said, our first ETF we're going to use today is going to be none other than the IWM. And the IWN is going to be the Russell 2000 ETF. If you guys have never heard of this ETF before, then whenever you go ahead and jump into it, just go ahead and scroll down so you could get some more information about what this ETF does, the amount of sectors it's involved in, and most importantly, the top 10 holdings. Now, this ETF is going to give you an idea of stocks that you should be trading as well because it's quite simple. If these stocks are the top 10 stocks in an ETF that's very popular like this one, if it's good enough for them, then it should be good enough for you. Now that we're here on the Russell 2000, we're going to go ahead and go to trade IWN options in the bottom in order for us to go ahead and open up our options chain. Now, if you guys are new to options, then this entire area down here is known as the option chain. The option chain gives us enough information in order for us to make a very informed decision before entering any options contract. Now, speaking of option contracts, before we go ahead and jump right in, I always have 2 requirements for my viewers and also my subscribers. Requirement number 1, always make sure you do your own due diligence before entering any options trade. What might work for my portfolio, quite frankly, may not work for yours. Requirement number 2, always make sure to have an exit strategy before entering any trade. That way, if the trade were to go against you, then you know how to get out of that trade. Now, for this first option strategy, we're going to go ahead to sell, we're going to go ahead to put. Now, this option strategy is also going to work if you're a college student. I'm going to show you how to make consistent income in order for you to buy a little extra something while you're in college. So we're going to go to sell, we're going to go to put, we're going to go ahead and choose our strike date. Now, the reason why ETFs are perfect if you're trading with small accounts, here's the number 1 reason. ETF have daily expirations. So you can literally do trades every single day once you're trading an ETF. For today's video, however, we're going to be choosing a strike date just 1 month out. And there's a reason I'm going to go ahead and do that. I will show you why as the video goes along. So we will be going with August 1st, and that's going to give us 27 days to expiration, which is roughly about a month. Now we're going to go ahead and we're going to choose our strike price. The strike price we're going to be using, we're going to be getting our strike price based on what's known as a chance of profitability. As you can see to the top here, we have chance of profitability. So the number 1 criteria in order for you to start off this option strategy is simply going to be a chance of profitability. That being said, that's going to tell you you do not need to know any technicals. You don't need to go over the fundamentals. You're just going based off the chance of profitability. Now, we're going to start off with a 75% chance of profitability. And the closest to that, we're going to go with this one here, which is 76% chance. Now, the corresponding strike price for this 76% chance is going to be 216 strike price right here. So we're going to go ahead, we're going to select that. The reason why you're going to be looking for a 75% chance of profitability is that that's going to tell you there's a 75% chance that this trade is going to go in your favor. Now, vice versa to that, that means there's also a 25% chance that this trade can go against you. Now, this is going to be representative of a 2-leg option strategy, and this here is going to be the first leg of that option strategy. Now we're going to go ahead, we're going to go to buy, we're going to go to put, and now we're going to be going ahead and choose the next strike price. The next strike price we're going to be choosing is going to be directly below the previous strike price we choose, which is going to be the 215. We're going to do this for simplicity of this video. So your first strike price, whatever it is, your next strike price is always going to be directly below your first strike price. We're going to go ahead, we're going to click into that one now. We're going to hit continue. We're going to hit review order. So with this first ETF, which is the IWM, in order for you to use this with a small account, you're going to start off with the main criteria. The main criteria is going to be your chance of profitability. Once you go ahead and you decide that, then you're going to find out the corresponding strike price. Once you do that, you're going to go ahead then and go to your second leg of the option strategy and then choose the next strike price right below your first strike price. That's going to lead you to what's known as a put credit spread. The put credit spread is perfect for if you're new to options trading and also if you're trading with a very small account. The put credit spread is also known as a bullish option strategy. So once you do the put credit spread, you're going to be receiving money. The amount of money you're going to be receiving is going to be $23.92 right here, or we're going to round it up to $24. The collateral you're going to have to leave is going to be $100. So this is one reason that makes this perfect if you're trading with a small account, because you only need to have just a couple of $100 in your portfolio in order for you to perform this option strategy. Now, your rate of return on this option strategy is going to be 24%, which is extremely high. You're going to simply divide your $24 you receive for income. You're going to divide that by the amount of collateral you have to leave, which is going to be $400. Now, that is one trade, one option strategy you could use with this ETF. Before I go ahead and show you the other two ETFs that can be used, I'm going to go ahead and show you how to mitigate your losses here. So one way in which you could mitigate your loss, instead of scaling up means to have multiple contracts. What you could do is what's known as a staggered formation. So with the staggered formation, you're going to have this first trade in your portfolio. And let's go ahead, we're going to remove it right now. And then we're going to go ahead and do another one. Remember, the date for this one is going to be August 1st. Now we're going to go ahead, we're going to choose a week away from August 1st, and that's going to give us August 8th. We're going to be going ahead and choose the exact same strike date, which was the 216 strike price, So we're going to choose that. And then we're going to go to buy and put, and we're going to be choosing the price right below. Once again, the 215. Going to go ahead, click that. And once again, this is going to be another put credit spread. The rate of return now is going to be $26. The amount of money you're going to be leaving as collateral, once again, is going to be $100. The reason why this is going to mitigate your risk is because now you're able to give yourself another extra week. Now you have two trades. You have the first trade, which expires on August 1st, and now you have a second trade, which expires August 8th, and now you're utilizing only $200 of your portfolio. So again, this is perfect if you're trading with a small account. Now I'm going to go ahead and show you another way in which you could mitigate your risk. So we're going to go ahead, we're going to come out of here. And now what we're going to do, we're going to go ahead and go 2 strike prices below our first strike price. And that's going to give us a 214. Let's go ahead and click that. So remember, our first strike price was 216. And within the first example, we just went 1 strike price below. Now we're going 2 strike prices below. This now is known as a $2 widespread. So you're going to subtract your 216, you're going to take away 214, and it's going to give you $2. So in the option world, this is a $2 widespread. The reason why this is going to reduce your risk is because now when the share price goes down, in order for this trade to go against you, the share price always have to go past your second leg, which is going to be 214. This new trade reduces your risk because previously your bottom leg was 215. So now the share price needs to go even further down below the 215 to your 214 in order for the trade to go against you. Now, the other reason why this mitigates your loss is that now instead of having 2 trades that cost you $200, you could now have one single trade that costs you the same amount, which is $200, so now you only have 1 trade to monitor. So those are just some tricks that could be used in order for you to reduce your risk and increase the odds of these trades going in your favor. Now I'm going to go ahead, I'm going to show you the second ETF that can be used, and then I'm going to go ahead and explain how this trade is going to work out. So let's go ahead and clear these parameters in order for us to jump into the new one. And the new one is going to be none other than QQQ, which is Invesco Triple Q. Now, you could do the exact same thing for invest code triple Q. If you've never heard of it, just go down and get some information about it. So let's go ahead to trade QQQ options. We're going to be going to sell. We're going to be going to put. We're going to be choosing the exact same 1 month expiration, which gave us August 1st. Then we're going to go ahead to choose our strike price. Once again, the criteria we're going to be looking for is a 75% chance of winning, and that's going to give us the 543 strike price. Let's go ahead, let's select that one. We're going to go now to buy. We're going to go to put, and we're going to choose the next strike price right below our previous strike price, and that's going to give us the 542.5. Now we're going to skip this because we don't like to do the half prices, and I do have a video of why. So we're going to go ahead to the 542. We're going to go ahead, we're going to select that. Once again, the put credit spread. We're going to hit continue. We're going to hit review order, and the exact same thing. In order for you to do this put credit spread on a different ETF, which is the QQQ, your collateral is going to be $100, and the amount of credit you're going to be receiving is going to be $24. Feel free to use any one of these 3 ETFs that suits your fancy, whichever one aligns more with your goals. The rate of return on every single one of them is going to be super, super high. Another reason why ETFs are best if you're trading with a small account is because the volume on ETF is very, very high. The volume is important because it's going to allow you to enter and exit the trade with ease. So before we go ahead and get into the third ETF that could be used for small accounts, I'm going to go ahead and explain to you how this trade goes. So come expiration date of August 1st, if this share price right here stays at any price above the 543, which is your first strike price you chose, then you will get to keep your $24 credit, and you're going to get this $100 released back to you in order for you to go ahead and do this trade again, or to use that $100 to do another option strategy. Now, in order for this trade to go against you, come expiration date once again, this share price right here, it needs to be below your last strike price you chose. In this case, it's going to be the 542 price. Once that happens, then once again, you're going to keep your credit. This credit is yours to keep no matter what. That's why this is a perfect option strategy for small accounts. You're always going to keep getting money. But now you're going to lose the collateral. The amount you're going to be losing is going to be this $100 right here. Now let's go ahead and jump into the third ETF that's perfect if you're trading with a small account, and that's going to be none other than the Spider ETF or SPY. Let's go ahead and open that up, and we're going to go ahead and jump right into the options chain. So let's go to trade SPY options down to the bottom, and we're going to be doing the exact same walkthrough. We're going to be going to sell, we're going to be going to put, and once again, our monthly expiration date. That's going to be August 1st. We're going to go ahead and look for a 75% chance. Remember, the whole point of this option strategy is if you're new to options and you're trading with a small account. So if you're new to options, you're not fully aware of the fundamentals and also the technicals. So you're using simple strategies to get started. And the simple criteria you will be using is just a chance of profit. And once again, we're going to go to the 75% chance. And then we're going to see the corresponding strike price. That's going to be 613. We're going to go ahead, we're going to select that. Now we're going to flip the switch once again, go to buy, we're going to go to put, and we're going to go $1 down. Remember from the first example, we had a $2 widespread. Now we're going to maintain a dollar widespread. So we're going to go to the 612. Let's go ahead, get that in. So here you go once again, the put credit spread. And with this one, the estimated credit is a bit lower, but in my honest opinion, after being trading for more than 6 years, this one is the best ETF to get involved in because this one has the highest volume in all of them. Now, the way how I did the video, I got started with IWM, which has a lot of volume, but in the 3, it has the least volume. Then comes the QQQ, and the one with the most volume is always going to be the Spider ETF. So there you have it, investors and future investors. If you're new to options trading, and particularly if you're trading with a small account, the 3 best ETFs for you to use and get to know is going to be the Spider ETF, which is going to be SPY, the IWM, which is going to be the Russell Shares 2000, and also the Triple Q, which is going to be the investor QQQ. By using these three ETFs, you could go ahead and implement one simple option strategy, which is going to be the put credit spread, and you could use that in order for you to make consistent income. Now, I did show you the example of going 1 month out. Feel free to use daily expirations if you want. Now, with daily expiration, just remember, always keep looking out for the PDT rule, which is the pattern day trader rule. So for those of you that made it to the end of the video, now would be the perfect opportunity for you guys to go ahead and like the video. Subscribe to the channel. Make sure to hit that notification bell to get an alert when I post a video. But most importantly, the whole purpose of me making these videos is that I'm trying to help as many people as I can get away from the 9 to 5 by earning income with options trading. So if there's anyone out there you know struggling to grow a small account portfolio, then the best thing to do is to go ahead and share this video with them. Together, let's help as many as we can. Now, until the next video, keep pushing your investments.